Welcome everyone. Thank you for joining us on today's webinar. This is Jigyasa from Webtel, welcoming you to the detailed analysis of Union Budget 2022. As we all are living in the world of digitalization, where technology is converting each complexity to simplicity. That's why Webtel came into being to make IT a way of life. We are India's leading e-compliance companies known for its compliance management, office management, and HR management solutions. We have Knowledge Academy as well, where you can do all of your learnings by opting for self-paced courses, staying in line with the blogs, keeping pace with webinars, etc. Today, we are presenting a webinar on detailed analysis of Union Budget 2022 in association with the AFTP, presented by our renowned speakers CA Rajiv Khandelwal, CA Pidam Goel, CA Tushar Agarwal, and CA Abhishek Gupta. AFTP vision is to provide qualified opportunities to members for their professional development, continuing education, peer-to-peer networking, and ongoing member benefits in order to improve services to our respective clientele. So now, let me introduce you to the moderators of the day. CA Rajiv Khandelwal. He is the fellow member of he is the fellow chartered accountant of ICAI. He is also DISA ICAI, a certified system auditor. He is also an alumnus of Sri Ram College of Commerce. He has over 3 decades of experience in the compliance sector. Mr. Khandelwal has addressed thousands of webinars and seminars so far on compliances at various forums such as NASCOM, Institute of Chartered Accountants of India, Institute of Company Secretaries of India, Institute of Cost and Work Accountants of India, and various study circles. Our second moderator is CA Pitam Goel. CA Pitam Goel is a founder partner of AFTP and Tatvam Advisors. He is a newly elected member of NIRC of ICAI, having over 10 years of professional experience in the field of valuation advisory, compliance, indirect taxes, business finance, and due just business finance and due diligence, business advisory. He is a member of Institute of Chartered Accountants of India, having held all India merit positions at all stages. Mr. Goel specializes in providing valuation under various statutes such as the Company Act, RBI, Income Tax, IBBI, AIF, etc. Valuations such as share entitlement ratio under M&A, fairness opinion, business, ESOP, brand intangible, impairment testing, FDI, ODI, derivatives, etc. For various industries ranging from real estate, BPO, manufacturing, EPC, hospitality, etc. He specialized in providing services related to virtual CFO, business or financial planning, leveraged fundraising, asset management, and financial modeling. Now I'm handing over the mic to the CA Pritam Goel for taking this session. Sir, over to you.
Thank you, Jigyasa. Good afternoon to all the participants. AFTP, along with Webtel, would like to welcome all the delegates for the webinar on Budget 2022 updates. AFTP and Webtel would also like to welcome our esteemed speaker for the day, CA Tushar Agarwal, co-founder Tatvam Group, and CA Abhishek Gupta, partner at B. Chintwani and Company, who shall be sharing with us their valuable thoughts with regard to indirect taxes as well as direct tax amendment through Budget 2022. In an ever-changing regulatory environment, friends, one of the biggest challenge for the tax professional is to update themselves with the changes and appropriately implement the same in their firm proactively with their organizations, people, and customer. This budget, when we talk about 2022.
Just a minute. I think somebody is facing some audio problem. Pikamji's voice is quite clear. But if still somebody is facing any problem, you can join on YouTube also, and we will share the link on chat box. You can go there if there is some issue. Otherwise, I think it is quite audible. Please continue.
Not an issue. So when we talk about this budget 2022, this has set the tone for digitalization and innovations in the business process. The key points when we talk about for budget 2022 is expansion of highways by 25,000 kilometers and the Gati Shakti master plan among the top priorities. When we talk about this Gati Shakti, this is a transformation approach which will integrate the logistics through roads, railways, ports, airports, transportation, road transportation, waterways, as well as logistic infrastructure. So this Gati Shakti will integrate all the civil engines, and the economy will benefit thereafter. There would be contracts for 4 multi-model logistics parks under public-private partnership model, and that shall be awarded in financial year 2022 and 2022-23. This will boost cargo logistics and multi-modal connectivity. So if we see these two key reforms with regard to Gati Shakti as well as multi-modal logistics park under PP model. So if we see integration between these two, the intent of government is to have a logistics in place with regard to all the 7 engines, as well as with the logistics park wherein the warehouses can be developed for storing the goods for the supply. So the ultimate aim of the government in this budget 2022 is digitalization and innovations with regard to transportations of the goods. So other important key parameters for 2022 budget is to promote drone making, basically for agriculture produce, for pesticides, etc. Then the intent is to have the national telemedical health programs to be launched with network of 23 telemedical health centers across India. The intent is to have the digital universities for providing access to schools, 5G spectrums to be auctioned in calendar year 2022. Another key parameter is battery swapping policy to be brought out. If we see the electronic vehicles policy, FAME 2 policy, which government has ruled out through Department of Heavy Industries. So if we see that the electronic vehicles are becoming a popular source and a new industry and a key industry, the main integrant of the electronic vehicle industry is the battery. So when we talk about the battery swapping policies to be brought in, this will definitely boost the business of the electronic vehicles. What does this battery swapping means? जो मेरी old batteries हैं, जो मेरी आज electronic vehicles के अंदर old batteries लगी हुई हैं, मैं उसको देके नई batteries कैसे ले सकता हूँ? That policies revolves around the same. So this would be the big reform when we talk about with regard to the electronic vehicles. So any of us, in case we are giving any advice to our clients with regard to EV companies, this is a policy wherein we can also develop our expertise. As a professional, we can also develop our expertise and give the services to our clientele, and thereafter integrate what we provide with the business processes with the other policies also. There are amendments under IBC Acts to make it more efficient and to enable the cross-border insolvency resolution, the most important part. अगर मेरी इंडियन कंपनी इंसॉल्वेंसी के अंदर है, तो मेरी जो सब्सिडी है, अगर वो सब्सिडी फॉरेन सब्सिडी है, so the amendments will be carried out in IBC so that जो मेरी सब्सिडी फॉरेन के अंदर है, I am able to sell those companies, I am able to get a control of those companies. So there will be cross border insolvency resolutions also coming up with this budget 2022. The special economic zones, when we talk about, has to be replaced with the new legislation. State will be looking into the same, and we will have the new legislature with regard to the SEZ. RBI intend to issue digital rupee using blockchain and other technology. Introduction of the digital rupee will start in financial year 2023. Sorry. There will be an expert committee to examine holistically with regard to venture capitalist, PE, and their areas for frictions. Another important point when we talk about is there has been a provision made for payment of 75% of the RA bills, running bills, mandatorily within 10 days, and for encouraging settlement of disputes through mutual discussions. This will definitely increase the transparency and reduce the payment delays which MSME as a division was facing, and this will enable their better cash flows. So these are the few key parameters which intend to boost up this budget 2022. Now I would like to invite CA Rajiv Khandelwalji, Director Webtel, to share his thoughts about the budget 2022 and introduce the speakers for today.
Thank you, Pitamji. That was very insightful, and you gave a very succinct and brief analysis of the budget macro indicators, particularly. And from my side, I'll just talk about a few things. So thank you so much, Pitam. Now, I'll just talk about a few things which I observed in the budget. Rather, the micro indicators which are more relevant to our day-to-day practice. One, I think you might have read in the newspapers, etc., also, or listened to the budget speech that many pharma companies, they incur a lot of money on giving various gifts to doctors, etc., expensive cars, expensive foreign tours, etc., iPhones, all these kind of things. And that has been clarified that that's not deductible under Section 37. So that is one thing, because it violates Indian Medical Association's regulations. So that's not allowed. Similarly, as you're aware that many big companies give gift various tours, foreign tours, again, these expensive gifts to dealers, etc. And very conveniently, these companies are claiming a deduction for that also. But if you see Section 28, it says subsection 4, it states that even in these kind of value of any perquisites, cash free, whether they are in cash or otherwise, they are taxable in the hands of the person receiving it. But are you aware of any dealers, etc., who are declaring this as their income? So now that has been clarified that even law was always there, but people were not showing it, and very conveniently the companies were claiming deduction for that. So now that has been plugged, and now it has been clarified that these people need to show that in their ITR, in their income from business and profession. And even there will be uh, uh, TDS under Section 194R for that. So that once TDS is deducted, it cannot escape the ITR. So that is what they have done. Another thing, they wish to make various clarifications so that we comply with the law properly. And one of the clarification is that under Section 194IA, which is for deduction of TDS at the rate of 1% from property transactions other than agricultural land. So they have clarified that it is 1% of the sale consideration or the stamp duty value, whichever is higher. And I think everybody in these days goes with the stamp duty value only in the sale deed. But still, I think in some cases it was not done. That is why they have come out with this, again, a clarification that the higher of the two will be there. So very few cases might be there which are not selling at the circle rate or the stamp duty value. So even those will be covered. But at the same time, various other important things like deductions under Section 80JJAA, it is for employing additional workforce during the year. That is very ambiguous. And a lot of confusion is there for in which cases it is available, whether it is available for 1 year only or it is available for multiple years, and for each year you can get the deduction in 3 years. I think many of the people are unable to claim it because it is not a very clear scheme. So government needs to clarify the schemes which are for the benefit of the people also, and not only those schemes which are for its own benefit. So that is there. And again, if you fail to pay tax on time, then obviously the AO will issue notices and give orders for recovery of the TDS or the TCS, as the case may be, and interest has to be paid. Now there is again confusion as regards the amount of interest. So now it has been clarified that whatever the interest has been given in the order by the AO, that has to be deposited. What if it is wrong? So I think these kind of things should not be there. It is here, and we have to follow that. Another important thing, cryptocurrency. You are aware that government says that it's illegal and everything, and in spite of that, they are levying TDS on that, tax on that. So again, want revenue by any course. So that's okay. So in brief, these were the few things I wanted to talk to you about. And now we will not take much time and hand over the mic to the speakers. And let me introduce both the speakers of the day for you. Our first speaker is CA Tushar Agarwal. He has more than 10 years of experience in indirect tax. He's worked for more than 8 years with Lakshmi Kumaran and Sridharan attorneys. He was also deployed by the GSTN for GST implementation and has worked closely with government officials. He's worked extensively with government of India in designing GST returns, audits, and other formats. Our other speaker, CA Abhishek, is heading the Delhi branch of Messrs. Wadia and Company, Chartered Accountants, leading firm in audit and taxation matters. Abhishek was All India Rank 1 in CA Finals in May 2012. His core area is consulting on direct tax and accountancy matters. He has worked with and advised a lot of companies spread across varied industries and has domain expertise in the real estate industry. So without wasting much of time, I would request the first speaker of the day, CA Tushar Agarwal, to share his views on the budget. Thank you so much.
Thank you so much, Rajiv ji. Akash, can you allow me to share my screen? Can you please exit this? Let me just share my screen. Thank you, Rajiv ji, for your warm words. So, friends, we will be discussing the indirect tax amendments proposed in budget 2022-23. We will be discussing firstly the GST amendments and thereafter custom amendments. The first amendment is in section 16 of the CGST Act. Friends, we all are aware section 16 of the GST Act prescribes the conditions for availment of credit, such as there should be a valid tax invoice or a debit note for taking of credit. Goods should have been received in the premises for availment of credit. Another condition under section 16 is section 16(2)(c), that is, supplier should have paid the tax to the government. So there are various conditions which are prescribed under section 16. With effect from 1st January 2022, section 16(2) subclause A was already inserted, which provided that the details of the invoices or debit note must be furnished by the supplier in its outward supplies, that is GST1, and the same should be communicated to the recipient. Then only credit will be available. So one more condition was already added. So we had a condition called section 16(2)(c), which provided that the supplier should pay the tax to the government. Section 16(2)(a), which provided that the supplier should upload the invoice on the portal and it should be recipient in GSTR 2B. Rule 36(4) was also amended. Now, what they have done in this budget is that they have introduced one more condition for availment of credit apart from whatever conditions which we just now discussed. The newly inserted clause BA has been proposed, and the same is as under. The details of input tax credit in respect of the such supply communicated to registered person under section 38 has not been restricted. So they have introduced a new clause which says that the details of the input tax credit which have been communicated to you under section 38, and they have also substituted section 38, which we will see in another 2 minutes. The whatever details are being communicated to the recipient in GSTR 2B under section 38, that particular input tax credit should not be restricted. So that is one of the conditions which has been imposed. And let us now see what is section 38, and then we will see the interplay between section 16(2)(BA) and section 38. Section 38 has been substituted, and it provides that the details of the output supplies furnished by the supplier should be made available electronically to the recipient in the manner prescribed, and this is an enabling provision for GSTR 2B. So section 38 is just an enabling provision which provides that the supplier details will be auto-populated to the recipient details in GSTR 2B. And now what they have done is that in GSTR 2B, they have created two categories. First, ITC available. Second, ITC not available. And in what are the circumstances wherein ITC will not be available? That they have provided under section 38 subsection 2. There are 6 cases which they have provided that ITC will not be available to the recipient, even if it is auto-populated in GSTR 2B. I repeat, very important. Even if you are able to see the invoice on your GSTR 2B, still in 6 cases, ITC will not be available. Case number 1. Details of supplies furnished by the registered person within such period of taking registration as may be prescribed. So we await clarity on this particular serial number, but prima facie it seems, because they will prescribe it. If a supplier has taken a fresh registration and all of a sudden they are issuing huge number of invoices of huge amount, then they may restrict the credit for such kind of suppliers. This is even one of the tools which they use today also in BIFA to check fake invoicing, etc. That some companies take new registration and immediately start raising huge number of invoices with huge amount, etc. at the initial stage of registration itself. So it prima facie seems that that is the intent, but we await clarity how it will be implemented and what all will be covered in this. Second restriction, supplier has defaulted in payment of tax and such default has continued for prescribed period, meaning thereby that under this condition, the portal will check whether the supplier is discharging tax liability in GSTR 3B, whether he is paying tax under GSTR 3B and whether he is filing GSTR 3B or not. If GSTR 3B is not filed by the supplier, then the invoice, which even if it is auto-populated in your GSTR 2B, it may come out with the restriction credit not available. So they may provide restriction to those kinds of suppliers who are not filing their GSTR 3B. And that, so this is very, very important that my reconciliation is not only restricted to 2B versus books, that the invoice is auto-populated in 2B. That is not sufficient. I need to check whether the supplier is also regularly filing GSTR 3B or not. So that is the additional check which we all need to impose, which we all need to implement while we are doing our inward reconciliations with GSTR 2B. So one of the restrictions which they have imposed is if supplier is not filing 3B, I can restrict your credit. Next condition, that's restriction which they are imposing. Even if supplier is filing GSTR 1 as well as 3B. However, if the output tax payable in as per GSTR 1 is more than the tax liability paid through GSTR 3B and such difference exceeds the prescribed limit, then they may put restrictions or availment of credit. So we have seen in past, there are various suppliers who file their GSTR 1, say with the turnover with a tax liability of 1 crore rupees. But when it comes to filing of GSTR 3B, it's only 5 lakh rupees, 10 lakh rupees. So 3B, tax liability 10 lakhs. GSTR 1, tax liability 1 crore. Huge gap. But when you see your GSTR 2B, what will you see? Invoice is auto-populated. GSTR 3B is also filed. So you see that the supplier is compliant. Now, that is not sufficient. The portal will give you a report stating the difference between GSTR 1 filed by the supplier vis-a-vis GSTR 3B filed by the supplier in terms of percentage. And this is already implemented in the portal in last 1 week. So that report has started coming. So based on that report, the portal will themselves put a restriction on availment of credit. And now what will be the prescribed limit for such difference is yet to be known and will be soon shared by the government. Next, very, very important restriction which have been imposed under section 38. They are saying supplier has filed GSTR 1, it is auto-populated in your 2B, fine. Supplier has filed GSTR 3B, fine. The difference between GSTR 1 and 3B, no difference. Everything is reconciled, fine. However, if the tax paid by the supplier in GSTR 3B is out of input tax credit, which is not eligible. That is, if the supplier is discharging its output tax liability in GSTR 3B using those credit, which is not auto-populated in his GSTR 2B. And there is a difference between his credit in 3B and his 2B credit. And that difference exceeds the prescribed limit, in that situation also they can mark the invoices of such supplier as non-creditable invoices and can restrict the credit on the invoices issued by such supplier. So very, very important amendment. We are going one step back. It is not that I have to do my reconciliation and check whether my 2B and 3B is getting reconciled or not. I take credit on the basis of 2B. Fine enough. I also check whether he is filing GSTR 3B or not. Fine enough. I also check that there is no difference between his GSTR 1 and 3B. Like there should not be much difference. If there is much difference, they will put restriction under serial number 3. Apart from that, they are coming out and moving backwards, saying that even everything is reconciled. His GSTR 1 is filed, 3B is filed, no difference between 1 and 3B. But if he have paid tax using wrong ITC, if there is a difference of 2B versus 3B reconciliation in his books, in his returns, then also we can mark such supplier as invoices raised by supplier as non-creditable invoices. And it's a very, very big amendment. We are moving back to one stage, and it will be interesting to see how it will be implemented in the portal. Moving on to the next restriction, supplier has defaulted in discharging his tax liability in accordance with section 4912. That is, ITC can be utilized up to a specified limit of discharging output tax liability. Friends, we are aware that under Rule 86B, it provides a restriction that certain taxpayers can use only credit up to 99% for discharging the output tax liability, and the remaining 1% has to be paid in cash. If somebody is violating that rule, not following that rule, and there are certain exceptions to those rules. So whosoever is falling under that rule and he's not following that rule, in that situation, they can bar the invoices raised by such suppliers as non-creditable invoices. So they have come out with all those restrictions, all these restrictions in section 38 of the GST Act, and have provided that even if your invoices are auto-populated in GSTR 2B, it is not sufficient that you will get the credit. Please check whether he is filing 3B or not. Please check whether the difference between the GSTR 1 filed by him and GSTR 3B filed by him is within the prescribed time limit. If it is more, I will bar the credit. Next, also make sure that he is availing credit rightfully. There should not be inward reconciliation gap of in the books of the supplier. Whatever credit your supplier is availing in his books in his GSTR 3B, that should reconcile with his T2B, and there should not be much difference beyond the prescribed time limit. Burden on you. Next, you have to make sure if he is falling under Rule 86B, if he is covered under Rule 86B, then he is adhering to that rule in his return filing system. So availment of credit has become more stringent. It is very, very important for you to please amend all your contracts with the suppliers and ensure that if your credit is denied on account of all these reasons, etc., you are in a position to practically recover the money from them along with interest penalty, etc. So it is utmost important for all the taxpayers to rework the purchase order terms, work order terms, contractual terms with the vendors, and ensure that you have sufficient safeguard clauses with the vendors. Because practically what will happen is that if vendor has uploaded the invoice on GSTR 1 and he is effectively paying tax in GSTR 3B also, he will definitely demand tax from you. He says, I have appropriated my details in GSTR 1, I filed my 3B, he will definitely demand tax from you. So down the line, it should not come that these suppliers have not discharged the liability, these suppliers have used wrong credit for availment of, wrong credit for discharge of tax liability, etc., leading to unnecessary burden on you. So make it clear that if in GSTR 2B, your invoice is not creditable, make it clear in your contractual terms that whenever we will see the invoice auto-populated in my GSTR 2B, if the category of that invoice is ITC not available, we will not pay your GST amount. So we have to make sure your contractual terms are properly safeguarded to implement this section 38, which imposes big restriction for availment of credit, very big amendment. And most important, all these things are not in rules, etc. In last 4 years of GST implementation, we all have been taking argument for 2A, 3B mismatch, etc. that nothing is in the law. There is nothing in the law. Everything is in the rule, circular portal. Where is the act? Now, crystal clear. Please see, you have section 16(2)(c, which says supplier should pay the tax. You have section 16(2)AA, which says that supplier should upload the invoice on the portal and it should be communicated to you. Now we have section 16(2)BA, which says that the invoice should be auto-populated and it should not be restricted under section 38. It is the section 38 which contains all these restrictions. So section 16(2)C, 16(2)BA, 16(2)AA, multiple sections to restrict your credit. Most important amendment. Moving on to the next amendment, changes in time limit. Friends, we are aware that for availment of input tax credit, for issuance of GST credit notes, or for rectification of in GSTR 3B or GSTR 1, we have a time limit prescribed under the GST law, and that particular time limit is due date of furnishing GSTR 3B of September month of the next financial year. Take an example for the financial year 2021-22. Whatever invoices I am receiving, I can take credit only up to due date of furnishing of 3B of September 2022 month. So I have to record those invoices maximum in my book by September month and take the credit in my September 3B, which I have to file within the due date, that is 20th October 2022. Similarly, we have such restrictions for issuance of credit notes and rectification in returns. Now, what they have done is that they have extended this time limit to 30th November. Instead of due date of furnishing of 3B of the September month, the revised time limit is 30th November of the next financial year, and it's a very, very welcome relief. Let us understand this amendment with the help of an example, and there is a big catch in this amendment. When we see 30th November, at a glance, it looks like whatever invoices I am recording by 30th November in my books, I will be in a position to take the credit. Is that so? Let us understand with the help of an example. Invoice is dated April 2021. I repeat, invoice is dated April 2021. What is the last date of availment of credit? The last date of availment of credit as per the revised timeline is 30th November. And how do you avail credit? Please note, friends, availment of credit under GST law is through filing of return, and it is not your book entry. It is not the date on which you are booking in your books of account. It is the date on which your return is filed, in which you are including this particular invoice. Now, since the last date for filing, availing the credit is 30th November, so practically for this particular invoice of April 2021, you can avail the credit maximum in October 2022 return. I repeat, you can avail the credit maximum up to October 2022 return, which you can at best file up to 30th November. Though due date is 20th November, even if you delay it and file up to 30th November, the credit will be available to you. So in fact, by virtue of this amendment, the relief is only of one tax period, one additional tax period. You have to include all these invoices in your October GSTR 3B and file it up to 30th November. It is not the case that you don't include these invoices in your October 2022 3B. You rather book these invoices in your 30th November date and then file your November return in 20th December. Credit will not be available because the due date of credit, availment of credit is the date when you are filing your 3B return. So it is your October return. So they have shifted it from September return to October return, and that October return you can file up to 30th of November. Very, very important amendment. And if we see the extract of 43rd GST Council meetings, friends, no amendment is proposed in GST law in budget directly. It has to be first approved by GST councils. And when we see the GST Council meetings, these meetings, the minutes of these meetings explain the rationale and reason behind each of the amendment. And when we take out the extract, they specifically says, I'm reading the extract as it is. Law committee has recommended that a fixed date, 30th November, be fixed for the same as it serves two purposes. In the portal, after the cutoff date, no amendment would be permitted. Second, it provides one more month to taxpayer. So it provides one more month to taxpayer. Similar implication we follow for issuance of credit note and rectifications of returns. So everything you can do up to October return that you have to file by November 2022. by 30th November 2022. Moving on to the next important amendment is substitution of section 53. Section 50 subsection 3 contains provisions for levy of interest in case of wrong utilization or wrong availment of input tax credit under section 4210. So the old provision, if we see section 50 is the section which provides for levy of interest. In section 50, we have a provision for levy of interest if there is a shortfall for output payment. But when it comes to wrong utilization of credit or wrong availment of credit, we only had section 50 subsection 3, wherein it was restricted that such interest will be applicable only in a limited situation of mismatch under section 42, that is double mismatch. There was no general provision for levy of interest on wrong utilization of credit or wrong availment of credit, etc. And there was a dispute whether if I wrongly avail the credit but don't utilize, whether interest applicable. If I utilize wrongly, whether interest applicable. What will be the rate of interest, whether 18%, 24%. Everything has been put to end. Government has come out with a retrospective amendment wherein they have substituted this section 50 subsection 3. And now the section read as under. Where the input tax credit has been wrongly availed and utilized, the registered person shall pay interest on input tax credit wrongly availed and utilized at such rate not exceeding 24%. And they have also introduced a notification where they have retrospectively put rate of interest as 18%. Thereby, the implication is as under. If you have wrongly availed input tax credit, but you have not utilized, the law is crystal clear, no interest applicable on you. Second, if you have wrongly availed and utilized the input tax credit, availed as well as utilized, and there is a revenue loss to the government, then interest is applicable. And what will be the rate of interest? Crystal clear, 18% and not 24%. Moving on to the next amendment. Friends, I am covering all my indirect tax amendments and I will be taking all the question and answers in the end. Rest be assured that each of your question will be answered in the end. You can keep on writing in the chat box. Moving to next amendment under section 41. In section 41, the earlier section 41 provided for provisional availment of credit. Now they have done away with this concept of provisional availment of credit. They have provided that the credit will be availed in your GSTR 3B based on your self-assessment. Further, they have provided that if you have availed the credit, but supplier has not paid the tax, very important, please listen. If you have availed the credit and the supplier has not availed the tax, then the same has to be reversed along with applicable interest in the manner to be prescribed. It is yet to be prescribed. So they have put specifically in section 41 that if you have availed the credit, but supplier has not paid the tax, you have to reverse the credit. However, a proviso has been added and it's a very, very welcome proviso. It provides that, provided that where the said supplier makes payment of the tax payable in respect of the aforesaid supplies, the said registered person may re-avail the amount of credit reversed by him in such manner as may be prescribed. Now they have provided with the opportunity to re-avail the credit. So what section 41 is saying that you have taken credit, supplier has not paid the tax, we will ask you to reverse the credit. In what manner they will prescribe it, what will be the procedure. However, in future, if they pay the tax in such a situation, you will be in a position to re-avail the credit. So we will wait for the rules and more clarification from the government how this section 41 will be implemented. They have amended or omitted section 42, 43, 43A. All these sections provided for two-way flow. The earlier GSTR 1, 2, 3 model, which was emphasized during the implementation of GST. The entire section 37 to 43A has been restructured in a manner that there is no two-way communication concept. They have given GSTR 1, GSTR 3B, GSTR 2B legal sanctity. They have given 2B versus 3B reconciliations legal sanctity under the GST law, and entire provisions related to two-way flow has been deleted from the law. Moving on to the next set of amendments is under section 37 and 39. First, supplier would not be allowed to file GSTR 1 of the subsequent period unless the GSTR 1 of the previous tax period is filed. So if you have not filed GSTR 1 for this month, you will not be in a position to file GST1 for the next month. Condition imposed under the Act itself. Next condition imposed under the Act itself. If I have not filed my GST1, I will not be in a position to file my GST3B. If for January month, I'm not in a position to file GST1, I will not be in a position to file GST3B. In condition imposed under the Act. And whatever condition, whatever amendments we are discussing, all those amendments are effective from the date of enactment of finance bill. However, this interest amendment is implemented retrospectively. This is retrospective interest, and all other amendments are from the enactment of the Finance Act. Another amendment is in section 54, wherein they have changed the time limit for availing the refund in respect of supplies to SEZ units or SEZ developers. Under section 54, there is a time limit that I have to apply refund within 2 years from the relevant date. And in case of supply to SEZ developers, they have changed that this relevant date will be the due date of GSTR 3B in which supplies to SEZ was made. So from that, you have to calculate this 2 years period. Another amendment has been imposed is in section 49, subsection 10. Earlier, this section provided for transfer of cash ledger balance from one head to another head within the same GSTN number. So you could have transfer from one head to another head within the same GSTN number. Now what they have proposed is that apart from whatever is available under the Act, they have said that you can now even transfer the cash ledger balance from one GSTN number to another, to different GSTN number, but under the same PAN. That is, you can transfer the cash ledger balance from one GSTN number to another GSTN number, but under the same PAN, that is between distinct person. However, please note, it is only the CGST or the IGST credit that can be transferred to the distinct person as CGST or IGST. You cannot transfer the CGST under the state tax head. So what you can transfer is only the CGST and the IGST part. A very important amendment, but practically it is not yet implemented in the portal, and it will take around 1 month to get implemented in the portal. Next is insertion of section 4912. The purpose of this section is to give an enabling power for the insertion of Rule 86B. Friends, we are aware Rule 86B deals with restriction of credit for payment of output liability. That is, the maximum credit which you can utilize is up to 99%. So that restriction was imposed only under the rule, and now they have inserted a section specifically to give this power to the government so that there is no dispute in future and nobody challenges the constitutional validity of Rule 86B. And then we have other miscellaneous amendment, like they have proposed late fees for filing of e-commerce returns of GSTR 8. Similarly, they have provided that composition dealers or normal taxpayers who are covered under quarterly schemes, etc., monthly they have to pay an amount. So they have amended law to that extent. So these are miscellaneous kinds of amendment. And one more amendment is in respect of taxes, in respect of services by way of grant of alcoholic liquor license against consideration in form of license fee. All those liquor license, etc., they were already amended. The law was already amended by notification 25 by 2019, wherein it was treated neither as a supply of goods or nor supply of services. Now they have made it retrospective. Though it was amended in 2019, but they have made it retrospective that there will be no tax on this particular transaction. With this, now we will move on to custom amendments, and we will briefly discuss the custom amendment. Very, very important amendment, the first set of amendment under the customs law. They have made various changes in section 2, section 3. They have inserted section 51A, 51B, section 110A. Why all these amendments, series of changes? The purpose of all these amendments relates back to the Supreme Court judgment in the case of Canon India, wherein it was held that the officer of DRI does not have the jurisdiction to issue show cause notice under the Custom Act, because Custom Act is not properly drafted and it does not confer power to the board to assign the functions of proper officers to the officers of DRI. So effectively, there was a Supreme Court judgment in the case of Canon India, which said that DRI cannot issue the show cause notice because the way custom law is drafted, it does not give that power to the DRI officer. Now to curb that, they have introduced series of amendments. They have amended section 2 subsection 34, wherein they have specifically amended to provide that the assignment of functions of proper officer will be done by the board as per section 51A and 51B, and they have introduced new section 51A and 51B. These sections empower the board, the principal commissioner of custom or the commissioner of custom to assign functions of a proper officer to any officer of custom. Similarly, they have amended section 3 to include DRI officers under this ambit. So all these amendments together, the purpose of all these amendments is to overcome the impact of Honorable Supreme Court decision in the case of Canon India, which hold that DRI are not the power officers to issue a show cause notice. So to overcome this amendment, they have made this series of amendments. And apart from that, they have made this amendment retrospective. Again, an amendment which is retrospective. Supreme Court, larger bench has held DRI cannot issue a notice. Now we are amending the law and making it retrospective. Clause 96A, validation clause have been inserted, and it provides that all these amendments will be retrospective. So the intent of the government, why these amendments are clear, they want to say specifically that DRI are now the proper officers to issue show cause notice, and whatever they have done in past is legally valid. Now, as a consultant, we all have to analyze all these amendments in detail and see whether these amendments are in fact sufficient to overcome the impact of the Supreme Court decision in the case of Canon India, and whether this clause 96A of the finance bill, which makes it retrospective, is valid or not. So it is something which has to be analyzed in detail, and we will shortly come out with a write-up on this particular topic also. Another important amendment is in IGCR rules. Customs import of goods at concessional rate of duty rules. So these are the rules which are under the customs law. So whenever you are claiming any exemption, notification benefit, concessional rate benefit, and in case of import of goods, there are certain notification which puts a restriction that you have to follow the procedure which is there under the IGCR rules. So they have amended this particular procedure. Now what they have said is that they have made this procedure automatic and digitized everything. So you have to file an application on the online portal in IGCR 1 format. They will issue you an identification number, and that number you have to mention under each of the bill of entry, and then you have to give a monthly statement. So there is a complete process which they have prescribed under the IGCR rules, and the purpose of this process is to make it automatic only. SEZ Act will be replaced by a new legislation. We all wait what will be the new legislation, what will be the extra benefits which will be given to the SEZ developers, SEZ units, etc. So it's a big impact. The entire SEZ Act will be revamped, replaced by a new legislation, and we all wait to see what will be the development under the new legislation. So it's a big impact on the SEZ sector. And then we have various rate change, etc. I'm not drilling down into each of the rate change. Solar energy sector rate change, we are change in solar module. Then we have electrical and electronic items rate change. So there is a series of rate change. Various exemptions have been withdrawn, concessional benefits have been withdrawn. So there is a complete list which is available on the website which deals with various rate change. With this, we end our presentation on the various amendments proposed under the GST and Customs Act. Now I hand over it to Abhishek ji for carrying out the direct tax amendments.
Thank you, Tusharji. I'll just share my screen. So friends, the direct tax amendments in budget 2022 has primarily focused around settling few contentious issues, plugging a few gaps from a point of view of government so that they can increase the revenue, broaden the tax base, and a move towards a lesser litigation environment for the taxpayers as well as the government. As mentioned by Honorable FM also in her speech, that with a view that the government wants to maintain a stable and a predictable tax regime, there hasn't been much changes in the tax rates and the tax regimes which has been going around for last couple of years. Coming to the individual amendments, the tax rates, there is no change in the tax rates, and the tax rates for individuals, HUF, companies firms and all, everything remains the same. On the surcharge bit, there are a couple of changes. One important amendment, as everyone knows, for individual, there is a system of graded surcharge, wherein with each slab rate having higher surcharge rate going up to 37%. There was an exemption wherein there was a capping wherein capital gains for listed securities, long term as well as short term, there was a cap of surcharge of 15%. Now that cap of 15% surcharge has been extended to long-term capital gains of any and every kind. So section 112 has also been brought into the ambit of 15% capping surcharge. So this is one change in the surcharge, which is a welcome move, wherein especially people who sell, individuals selling properties or maybe unlisted shares and all, they were subject to a higher surcharge rate of up to 37%. Now it's will be restricted up to 15%. Another change in the surcharge wherein is the relating to the taxation of a cooperative society. They have tried to bring in it at par with companies. So what happens in companies, companies having total income above 1 crore but up to 10 crore, they are subject to a surcharge of 7%, and above 10 crore they are subject to a surcharge of 12%. In case of a cooperative society, it was always 12% above on a total income above 1 crore. So they have just tried to bring in at par with companies. So that's why this amendment. So if the income of any cooperative society is between 1 crore to 10 crores, the surcharge rate would be 7%. And similarly, to give another benefit to a cooperative society, and to bring it at par with companies, the rate, AMT rate, alternate minimum tax rate, has been reduced from 18.5% to 15%, which is also the MAT rate for companies. Now, coming to an important amendment which has been proposed by this budget is the concept of an updated return, which has been brought in by section 139(8)(a). Now, presently what happens is there is a concept of filing belated returns and revised returns, wherein the due dates for filing these returns is 3 months prior to the end of the relevant assessment year or completion of assessment, whichever is earlier. So now let us understand what happens is, practically speaking, for a particular assessment year. So let's say we do not consider the COVID extensions which have been given in last 2 years. In a normal scenario, end of assessment year, let's say it is 31st March 2022. The last date to file belated returns and revised returns for a 22 assessment year 22-23 return would be 31st December 2022. Whereas the normal dates to file the original returns in the case of a company is 31st October. If you are subject to a transfer pricing report, it's 30th November. In all other cases, 31st July. So practically what happens, an assessee, a normal individual assessee, gets 5 months time to revise his return if he finds there has been an error or omission on his part in filing the original return. Whereas a company assessee gets, or an assessee who is subject to a tax audit would get maximum of 2 months to rectify that return. Hence, what this budget proposes is that in case an assessee finds out that there has been an omission in his original return, a window would be given to the assessee to file an updated return, and that window would be up to 24 months from the end of the assessment year. However, it comes with a catch that the purpose of updated return is only if the assessee identifies an error and his tax liability increases. So an updated return cannot be filed if, as a result, there is an increase in the refund or there is an increase in the loss claimed by the assessee, or it has the effect of reducing the income which has been reported by the assessee in his original return. So what this return would allow, if an assessee finds out that is missed out on certain income while filing the original return, he would have a window to file a updated return up to 24 months from the assessment year. End of the assessment year, he'll have to pay the normal tax, interest, whatever is due, and along with that, the most important thing is that assessee will need to pay an additional tax of 25% or 50%. Now, what is this additional tax? Additional tax says कि जो भी उस assessee का tax due है, tax, surcharge, cess, interest, whatever is due. If the return of this updated return is filed within a period of 12 months from the end of the assessment year, he'll have to pay a flat 25% additional of the total tax, surcharge, cess and interest what he's paying. And if the return is being filed after 12 months but before 24 months, then the additional tax rate would be 50%. So basically this concept of updated return permits an assessee to find out an error. If he discovers an omission, he can file that return, but certain cost to the assessee in the form of an additional tax which he'll need to shell out. Now, coming to the next important amendment is the taxation of virtual digital assets. Now, over last few years, the transactions in virtual digital assets or cryptocurrencies, this has increased a lot, and there was no clarity in law regarding that taxation. We as professionals have come across through a number of queries from our clients ki facing. So to put rest to all the speculation regarding the taxation of virtual digital asset, the budget proposes clearly lays down the mechanism of taxation of these cryptocurrencies. So number one, the first amendment is in the definition section wherein the virtual digital asset has been defined what it is. The taxation of virtual digital asset is governed by section 115 BPH, wherein it says whatever income is arising from the transfer of virtual digital asset will be subject to a flat tax rate of 30%. And while computing this income arising on transfer of virtual digital asset, only the cost of acquisition will be allowed to be deducted from the sale consideration. So basically, to put it simply, whatever is the sale consideration of the virtual digital asset less the cost of acquisition, whatever is the income, it will be subject to a flat tax rate of 30%. On the contrary, and from this income, no losses are allowed to be set off and of any particular head. And if this particular income arising from virtual digital asset, instead of a income, it is a loss, then the assessee is not permitted to set off that loss with any other heads of income, nor is permitted to carry forward such losses. To put it simply, profit hai to you will have to pay tax at 30%, loss hai to that loss is yours. In a way, it may be a move from the government to discourage trading in such virtual digital assets. Similarly, couple of other changes wherein they have brought in to capture virtual digital assets is by amending the definition of property in section 56, wherein virtual digital asset has also been recognized as an asset. So if any person who is receiving a virtual digital asset as a gift, it will be taxed in the hands of the receiver. And to monitor the trading of such transactions in virtual digital assets, section 194S has been proposed, wherein the person making payment to the transferor for transfer of this virtual digital asset would be required to deduct TDS at the rate of 1% of the sum paid for transfer of such assets. So basically the idea is just like property transactions and all other amendments, all other purchase transaction which has been brought into the ambit in last few years. The idea is to ensure that all the virtual digital assets transactions are properly reported and captured. There are the threshold limits are different for TDS limit. So if it is a normal individual HUF who is not having any business income or having business income, the turnover of which is less than 1 crore, unke liye threshold limit is 50,000. whereas for all other cases, the threshold limit is 10,000. So this by making these amendments, the law is now in a crystal clear manner. They have laid down what shall be the taxation of these virtual cryptocurrencies, virtual assets, without leaving any scope for litigation or something of that state. Now, coming to next set of amendments, also is a very important amendment. Again, this is an issue which we as professionals have faced a lot over last few years. Is related the return filing processes of companies who are undergoing business reorganization, such as mergers, demergers, etc. So we all know what these mergers, demergers, any business reorganization, IBC processes, these are all long drawn processes wherein it takes anything between a year or a 2 year to from the date of filing of the application till the date of the disposal of the order by the NCLT or the High Court. Now, what happens in these kinds of mergers and demergers? These mergers are generally effective from a back date, which is said to be a effective date. Let's say if one of my applications is pending in NCLT, wherein the effective date of transfer is 1st of April 21. And let's say that order comes by 31st December 2022. So during that period, what the merger is effective from 1st April 21. However, during this intervening period, there will be a time wherein the transferor and the transferee company would be required to file their returns. Now, what happens? The practical challenge which we face is if you file the returns of both transferor as well as transferee, and the order comes thereafter, which is effective from a back date. How do we take into effect that the transactions of the transferor company into the returns of transferee company? Revised returns ke options are also very limited because as we discussed, it is only, let's say, up to 31st of December. So what happens if that timeline is also gone? So it's a cumbersome process wherein you need to apply to CBD to get a special exemption for filing the revised return post the order. So what this section 170A is doing is that they will give an option of filing a modified return to the successor company within a period of 6 months from the end of the month in which the order is issued by the Honorable NCLT or the High Court, and the successor company will have the option of incorporating the results of the transferee companies into its own return. Now, what would be the format of this modified return? We all await those things. Once it gets notified, we'll get to know will it be a full-fledged return or it will contain only specific details in that modified return. Similar insertion has been brought in section 170, wherein a new section 170 subsection 2A has been inserted. The idea of this particular amendment is of late there were a lot of disputes. Taking my example, the same example, let's say a merger has been moved wherein the transfer date is 1st April 21. The order comes in December 22. During this period wherein the application is pending before the NCLT, an income tax assessment or a proceeding has been done on the predecessor company or the transferee company, which eventually ceases to exist with effect from 1st April 21 because of the merger order. A lot of litigations were being raised in the past wherein courts also held during this intervening period, the assessments which are done on the predecessor assessees, these are not valid because those entities cease to exist from the date the order is effective. So just to take care of that anomaly, this section has been inserted wherein it says that during the period of the pendency of the matter before the honorable courts, any proceedings and any decisions, any orders which has been passed on the predecessor company shall be deemed to be passed on the successor company, and any proceeding will not become illegal due to a subsequent order being done. This only, however, covers the proceedings which are done during the tenure of the pendency of the court proceeding, pendency of the appeal for the business reorganization. Once the order is done by the Honorable NCLT, any proceeding will now have to be done on the successor company and not on the predecessor company. There are practical cases we see a lot of assessments are proposed to be done on the predecessor company. A lot of notices are issued on those predecessor company, for which there is a settled law now. Supreme Court have laid down that any notice or any assessment which is proposed to be done on a predecessor company subsequent to a merger or a business reorganization, the notice has to be issued in the name of the successor company, and any notice which is issued in the name of a non-existent company is bad in law, and it's void of an issue basically. Now moving to next amendment is again, this amendment is in section 14A, which deals with the disallowance of expenses relating to exempt income. This is one of the most contentious sections wherein there have been conflicting views taken by the courts over past many years. One of the major contentious issues here, which this amendment tries to settle, is the disallowance. What happens to the disallowance if there is no exempt income? So let's say, for example, there is an asset from which an exempt income can be earned. However, there is no exempt income earned during the year. Courts have come out with conflicting views, wherein there are few judgments of Delhi High Court and Madras High Court and a few ITAT judgments, wherein the courts have held that if there is no exempt income, then there cannot be any disallowance under section 14A. That is, even after CBDT came out with a circular in 2014 or 15, wherein they tried to clarify that that disallowance under section 14A will still to continue even if there is no exempt income. Courts haven't taken cognizance of those circulars, and they still continue to rule that if there is no exempt income, there will be no disallowance under section 14A. Now this is the amendment which says there is an amendment has been done by way of an explanation, which says that disallowance of expenditure will continue to be done irrespective of the fact whether the exempt income has accrued, arisen, or received during the year. So this amendment is applicable from assessment year 22-23. So for all past periods, definitely the litigation may still continue, and the courts will be free to take their view, and the assessing officer will be free to take their view in the framing assessments. But however, from assessment year 22-23 onward, the law is clear. Even if you are not having any exempt income, there will be a disallowance of expenses which have been incurred for earning those exempt income under section 14A, read with rule 8D. Coming to the next amendment is insertion of a section 79A. Here is also the purpose of this section is to again plug the anomaly which was there in the law and a scope for revenue loss for the government. So what happened in the past is if there was an undisclosed income which was detected during the course of search and seizure or survey proceedings, there was no law which restricted the assessee to set off their brought forward losses or unabsorbed depreciation, etc., with those undisclosed income. There are certain restrictions laid down wherein during the course of assessment, if the assessing officer does some addition under section 68 or 69 or 69B, he has powers. He'll not give you benefit of those losses or brought forward losses. The law is clear for that. However, for undisclosed income which were detected during the course of search and seizure and survey proceeding, there were no specific restrictions provided in the law. So this section intends to curb that loophole, wherein it says that if any undisclosed income has been detected during the search seizure proceedings or a survey proceedings, no losses, no set-off of losses, unabsorbed depreciation would be permitted against such undisclosed income. And again, this is applicable from assessment year 22-23 onwards. Undisclosed income has been defined in this particular section only. Coming to next amendment, section 158 AB. This is a move towards litigation management from a point of view of the government, wherein they want to restrict multiple litigations being filed by the assessing officer or the department on a similar issue which is already pending before a particular high court or a Supreme Court. So this is just a mechanism to stop that particular thing. So what does this amendment says? This amendment says that, let's say if there is a question of law in the case of a particular assessee which is pending before a high court or a Supreme Court, and there is a similar question of law either in the case of the assessee or either in the case of the same assessee or in the case of some other assessee, let's say, and they propose to form a collegium of which will consist of 2 or 3 principal commissioner, chief commissioner. If they feel the question of law is similar, they would advise the principal commissioner under whose jurisdiction that particular case or the particular assessee falls, asking him not to file an appeal before the appellate tribunal or high court till the earlier matter has been disposed by the high court or the Supreme Court. This, however, is subject to the acceptance by the assessee. And what the department would do in that particular case, they would let's say, let us understand it by way of an example. There is one assessee A1 जिसके case में there is a question of law which has been ruled in favor of the assessee, and the department has moved in the assessee A1 has received a favorable decision from the commissioner appeals. Now the department proposes to move to ITAT challenging this order of commissioner appeals. On a similar matter, in case of some other assessee, there is already a pending appeal which has been initiated by the department. What the department would have an option from here, that department revenue will defer the filing of appeal before the ITAT. They will simply write to ITAT saying that this matter, this similar law, question of law is pending before some other high court, and hence we be permitted to file an appeal basis the ultimate disposal of the identical question of law by the high court or the Supreme Court. However, for exercising this option under section 115 AB, revenue has to take acceptance from the assessee. If the assessee does not give his acceptance, then the revenue will have to go with the normal process of filing of appeal and all. And if they do not file the appeal, then they would not have a recourse in future to go back to this section and saying कि जी हमने तो appeal file नहीं की थी because a similar matter was pending before some other high court. So it's a clear-cut procedure has been laid down how the department can approach for few matters under this particular section 115 AB. The purpose is very simple and clear, that the government wants to avoid multiple litigations being filed by the department on a similar issue in case of multiple assessees. Coming to next amendment, which is one of the most important amendments which we feel, and which is bound to cause multiple litigations in future. So as you all must be knowing, last year budget 21 had completely reformed the reassessment proceeding, wherein section 147 to 153 these were all revamped, a whole new set of procedures and were laid down, a whole new set of guidelines were laid down for the department in case they want to do a reassessment proceeding, starting with section 140, insertion of section 148A, wherein the department is bound to issue a notice to the assessee before initiating any proceeding under 147(8), that why a particular his assessment should be reopened under section 147 and passing a speaking order under that particular section, and also reducing the timelines of the reopening of these cases from 6 years to 3 years with a carve out for specific cases which may be opened up to 10 years. In the past 1 year already, this particular law has undergone a lot of litigations, wherein what department did, by virtue of notifications in March and April, they tried to defer these amendments which were proposed by last budget and which became part of the finance bill. They tried to defer that, the implementation of those sections up to 1st of July, and issued notices under section 148 and under the erstwhile law up to 30th of June. A lot of these notices were issued. I'm pretty sure यहाँ पे जितने लोग हैं वो somewhere or the other they must have come across those notices. And of late, last couple of months, majority of high courts starting from Allahabad, Rajasthan, Delhi, Calcutta, these high courts have taken a very clear view that those notices which are issued between 1st April 2021 to 30th of June 2021 under the erstwhile law, without following the processes which were laid down by the new provisions of 147 to 153, which became applicable from 1st April 21, those notices are bad in law and are to be quashed. Now, what has happened in this amendment of 149, if we try to understand in little detail, what 149(1) earlier said regarding the timelines is that in a normal scenario, a proceeding or an assessment can be reopened up to 3 years from the end of the assessment year, and for certain cases where there is an escapement of income represented in the form of an asset amounting to more than 50 lakhs or more, for those cases there was a higher cap of reopening up to 10 years from the end of the assessment year. However, in this particular case, there were a limited case of an income escapement which was represented in the form of an asset. Now, the amendment which has been proposed by this particular budget, which will be applicable from assessment year 22-23, is to widen the scope of this reassessment, which can be reopened up to 10 years, wherein they have said it will capture all income escapement cases which are represented in the form of an asset which was already there, and 2 more items have been added, wherein income escapement which is represented in the form of an expenditure in respect of a transaction or in relation to an event or occasion, or an entry or entries in the books of accounts. Now, this is something which will bring in a storm of litigation in the future, because this practically captures everything which the department can try to reopen. However, though there is a cap of 50 lakhs, the income escapement has to be 50 lakhs or more. However, it is very difficult to say that there can be an income escapement which is not represented in the form of an entry in the books of accounts. So an entry in the books of accounts can be anything and everything, which the department might feel that it is an income escapement. Though there are safeguards wherein the section says that assessing officer must have certain document in his possession or certain evidence which will give a reasons to believe that income has escaped assessment, and only in that case the income escaping assessment notices can be issued under section 148 by duly following the process which is laid down in 148A. However, we need to see how department will practically approach to these type of cases and what kind of litigation it will bring in future. However, there is one more explanation in this particular 10-year window, which says that any case which could not be reopened by virtue of the erstwhile amendment, erstwhile timeline of 6 years, cannot be now reopened under this new timeline of 10 years. So what does that mean? It means that let's say for cases up to assessment year 2014-15, there was a timeline of 6 years from the end of the assessment year. So cases up to 2014-15 cases, any assessment of assessment year 2014-15 could be opened up to 31st March 2021 under the erstwhile law. Now with this particular amendment, wherein the department can go up to 10 years, by taking benefit of this amendment, department cannot try to reopen assessment of assessment year 14-15 in a particular case which became time barred by virtue of the old law. To put it in a simple way, even after these amendments, any assessment prior to assessment year 14-15 cannot be reopened or reassessed by the department. Now coming to next amendment, it is more of a clarificatory amendment in section 43B. Now what 43B says that one of the provisions of 43B provides that any interest which is payable on loans or borrowings to banks, financial institutions, etc. are to be allowed only on payment basis, and any interest which has not been actually paid cannot be allowed as a deduction. This is what section 43B says. Now there was an explanation which was already there, that in case an interest has been converted into a loan or a borrowing, that interest will also not be allowed as a deduction, because there is no payment per se. It is just a conversion of a interest into loan or borrowing. So they have just extended that. The amendment seeks to extend that conversion bit, wherein it says that conversion into a loan or a borrowing, or if let's say that interest has been unpaid interest has been converted into a debenture or any other instrument by which the liability to pay is deferred to a future date, let's say a commercial paper or any other instrument which technically do not fall as a loan or a borrowing. Even in those cases, interest will not be allowed as a deduction. So this is an extension of a clarification which was already there in 43B. And again, this will be a prospective amendment applicable from assessment year 23-24. Coming to next amendment which has been done, there are a couple of amendments in section 56. It is more in the light of COVID-19 pandemic, which we have seen in last 2 years, wherein what section 56(2)(10) provides that any sum of money which a person has received without any consideration, it is taxable in the hands of the receiver if it exceeds rupees 50,000. Though there are certain carve outs wherein if it is received from a relative or from a charitable trust, etc., there are carve out. What two insertions have been proposed in section 56? Number one insertion is, if any person has received from any other person any money for the purposes of medical treatment on account of COVID-19 illness of that particular individual or his family member, that will not be taxable in his hand. This is subject to certain condition which will be notified by the government shortly. Any such amount which has been received by that individual for the treatment of his medical treatment, that will not be taxable in his hands. And the second amendment is, if any person, if there is a death due to a COVID-19 illness and the family member of such deceased person receives certain ex gratia from any person, be it employer or the government or some other person, so that amount will not be taxable. So there are two categories. If that money is received from the employer of the deceased person, then it will not be taxable without any limit. In all other cases, there is a cap of 10 lakh rupees. So if such sum does not exceed 10 lakhs, then it will not be taxable. If it exceeds 10 lakh, then the whole amount would be taxable. There are two conditions to it. Number one, this payment has to be received within 12 months from the death of such person due to COVID-19 illness, and there will be certain set of conditions which will be notified by the government shortly. This is a retrospective amendment which will be applicable from assessment year 21-22 onwards. It's a welcome move, because we've seen a lot of these kinds of support being given out to people who have been subject to COVID-19 in any form or the other, and these taxing such amount causes further hardship to them. So this is a welcome move on the part of the government. Coming to last set of amendments, couple of amendments it's a more to boost and to promote manufacturing and startups is one is in section 80 ICA, wherein the startups are already eligible for certain deductions if they fulfill certain conditions. So usme one of the important condition for eligibility of these startups, as this particular section had a sunset clause wherein only those startups which were formed before 1st April 22 were eligible to take benefit under this particular section. Keeping in mind the COVID-19 pandemic for last 2 years and the considerable amount of time lost by these startups in these testing times, government proposes to increase this sunset clause by one further year up to 31st March 23. So any further startups who are incorporated up to 31st March 23 may avail this deduction under section 80 IAC. Similarly, there's an amendment in section 115 DAB which allowed concessional tax rate for newly set up manufacturing companies. The concessional tax rate was 15%. However, one of the important condition for them to avail this concessional tax rate was those newly set up manufacturing companies had to start their commercial production within 31st March 23. Again, this timeline for commencement of commercial production has been increased by 1 year. So they up to March 24. So if they start their commercial production within 31st March 24, they can still be eligible to take the concessional benefit of 15% under this particular section of 115 PAB. Next amendment is in section 37. This is again stemming out from the conflicting orders of the views which have been taken by various courts in the past. One of the explanation of section 37 provides that any expenditure which has been incurred by the assessee, which is an offense or which is prohibited by law, is not an allowable expenditure under section 37. Another explanation has that explanation has been replaced, clarifying what does this particular term, any expenditure incurred which is an offense or which is prohibited by law, would mean. So there are 3 items which are added. Number 1, it says offense under any law in India or outside India. So pehle there was an ambiguity. What does this term law means? Does it restrict itself only to the domestic law or does it extend to a foreign law also? Now they have clarified that it extends to any foreign law as well. So if there is a company, let's say it has committed an offense in terms of a law of a particular foreign country, and in view of which it has incurred a certain expenditure, so that expenditure will also not be allowed under section 37. The second item is to provide any benefit or perquisites in violation of any law. Here, to give an example, let's say ICMR came out with certain guidelines for doctors in the past, wherein it prohibits doctors to receive any gifts from hospitals or pharma companies, etc. Now, in past, what happened that these pharma companies voluntarily gave certain gift vouchers, gifts, anything, a few things to gift, which they claimed as a business expenditure. Courts have again taken a different view in it. Some courts have allowed such expenditure, some courts haven't allowed. They have clarified that if any such benefit or perquisite is in violation of any such law, that will also not be allowed. So taking this example, since ICMR guidelines does not permit any doctor to receive a gift from a pharma company or any other person, any company or a hospital trying to claim expenditure or a deduction for such items will not be permitted. And thirdly, any expenditure which an assessee incurs to compound an offense under any law, that will also not be permitted or allowed as a deduction under section 37. So these are the 3 items which have been inserted by way of an explanation to settle the conflicting views which have been taken by the courts in the past. Next amendment is in section 40, and this is a retrospective amendment coming from assessment year 2005-06. So what had happened in the past, couple of judgments were passed by a Rajasthan High Court and a Bombay High Court, wherein it said key section 40, what does section 40 provide? That any tax and surcharge which is paid by an assessee on his income is not allowed as a deduction. So basically, jiski basis pe whatever income tax you pay, that income tax along with surcharge is not allowed. What these two judgments did in the past, they said ki the education cess and health and education cess, this is not a tax, neither it is a tax nor it is a surcharge, and it is not specified also in section 40, and hence one can take deduction of this health and education cess of 4%, which is additionally leviable on income tax which is paid by the assessee. So this is what couple of judgments had come in the past. Taking cognizance of that High Court judgment, a lot of ITATs were also passing similar orders. To put rest to that, the government has come out with a retrospective amendment from 2005-6 and clarified, which Honorable FM also clarified in a budget speech yesterday, that the term tax will always deemed to include any cess or a surcharge, and hence it is not an allowable expenditure. The courts had actually referred to some CBDT circular of 1967, wherein the objective, the intent was to refer to certain state cess imposed by certain state government, which should have been permitted. Coming to next amendment is in section 94. This is an anti-abuse provision, the 94 subsection 7 and 94 subsection 8, wherein there is dividend, which deals with dividend stripping and bonus stripping. So what happened in 94-8 was bonus stripping was only restricted to units of mutual funds. So in shares and securities, people were still, bonus stripping was still a legitimate way of tax planning. What this amendment seeks to do is it extends that bonus stripping provisions from mutual funds also to shares and securities. So going forward after this amendment, one cannot plan a bonus stripping in shares or some other securities. Similarly, the definition of units have been modified to extend the definition from not just from mutual funds, but to include investment trust and real estate investment trust and AIFs also within the definition of those units. The next amendment is or it is an omission of section 115 BBD. What this section provided in the past was that if any assessee had a foreign subsidiary or had 26% shareholding in a foreign company and it received dividend from such foreign company, that dividend was taxed at the concessional rate of 15% by virtue of this section 115 BBD. The budget proposes to omit this particular section, since now dividend received from a domestic company is also taxable at normal tax rate. This concessional tax rate was in the past brought in keeping in mind that dividend from a domestic company was tax free under section 1034. Since dividend from a domestic company is now taxable, to bring in parity on dividends received from a domestic company and from a foreign company, this section is proposed to be omitted, and henceforth any dividend received from a foreign company in which 26% or more is held by such Indian company, that will be taxed at the normal tax rate of such Indian company. Lastly, the last amendment is in section 194 IA, which provides for deduction of TDS in case of purchase of an immovable property. Earlier, the rate of deduction of TDS was 1% of the consideration amount. Now the amendment says it has to be 1% of the amount credited or the stamp duty value, whichever is higher. So it also just bring in a more reporting way of thing and putting a onus on the person who is making payment to deduct TDS on stamp duty value if the amount paid for such transaction is less than the stamp duty value. Thank you. Now, in case there are any other queries, we can happy to discuss.
Thank you, Abhishek. So let us take the question and answer. So I will be first taking up the indirect queries raised in the chat box. So the first query is, how we will handle the MSME vendors whose invoices we cannot hold. So basically, we understand that in case of MSME, there is a time limit within which you have to make payment to them. Now, within that time limit, you have to make sure that all those vendors, they are actually filing their returns on time, uploading the invoices on GSTR1, filing your GSTR3B on time, etc. Now, because of the new restriction under Rule 30, Section 38, etc., now if you have to make payment to them and you are not in a position to check whether they have filed 3B or not, you have to make sure that your contractual terms are very well drafted. So even if you have made the payment, you are in a position to recover back from them if there is any non-compliance from their side which is leading to reversal on your side. Therefore, it can be safeguarded only through contractual terms. How can we handle quarterly filing vendors? In this situation, there is a concept of IFF facility, invoice furnishing facility. So you can tell all your quarterly filing vendors to upload the invoices on monthly basis so that the same is auto-populated to you. See, again, I would like to clarify is that when we talk about Section 38 amendment, so ultimately, what is the concept now? The concept is there is no concept of GSTR 2A. Concept is only 2B will prevail. Whatever supplier uploads, that will be auto-populated in 2B, and you have to avail credit based on matching principles. That is, you have to match your 2B with your books and accordingly take credit. Down the line, you have to make sure that they are also filing their 3B on time. Apart from that, what Section 38 has done is that they will select few kinds of vendors who are generally not filing returns on time, or credit is wrong, etc. So whenever the portal with some logic will select those kinds of vendors who are covered under Section 38 restriction, whenever they issue an invoice and that invoice is auto-populated to you, in your GSTR 2B, there will be a sign credit not available. So in GSTR 2B, if you are getting 100 invoices, 80 will be credit available, 20 will be credit not available, and not available will be on account of those suppliers. 38 restrictions. So accordingly, whatever invoice is not available, whatever is showing in GSTR 2B that this is not available, so you cannot take the credit of that particular invoice. So it is advisable that you at least make a policy of waiting till your GSTR 2B gets generated so that you have a clear picture whether credit is available or not available. Please clarify the 30th November rule. I'm again repeating that earlier the time limit for availment of credit or issuance of credit note or rectification in return was due date of September month. Now it has increased to 30th November, meaning thereby that all this can be done up to your October month return. October month return, which you can file up to 30th of November at last. So there is a benefit of 1 month only. So effectively, one tax period benefit is available. So you have to take the credit maximum up to your October return, or you have to issue credit. You have to take the benefit of credit note maximum up to in your October month return, and you make sure that you have to file that return maximum by 30th of November. I have purchased coal in which there is a compensation cess, but I am manufacturing some other product. How can I use this cess? There is no provision to use this cess. You will not be in a position to claim refund, etc. I will take an example. You have purchased coal. In coal, there is a compensation cess, and you are manufacturing steel, and you are selling steel on which rate of tax is 18%, and there is no compensation cess. So whatever cess what you have paid on your procurement, you will not be in a position to claim credit or refund. However, in case you are exporting steel, if there is an export of steel, in that situation, you will be in a position to claim refund of cess paid on purchase of coal on proportionate basis to the extent of export turnover vis-a-vis total turnover. I think we have covered most of the indirect tax questions. Abhishek ji, you can take the indirect tax part.
So
Indirect tax part, sorry.
indirect tax mein there is one question: can assessee file appeal with ITAT for same question of law? Yes. So this particular section 158(8)(BA) is only from a department's point of view. Assessee can still continue to file as number of case appeals for same question of law. Next question is, if I not being employer by annuity plan of rupees 50 lakhs for family of my friend died due to COVID, whether that payment to insurance company will be taxable in the hands of family member. So this would really depend upon what exactly insurance plan you have taken, for how long you have taken, and whether it falls within the exemption of section 1010D. So this particular section amendments in 56 is not trying to deal with any insurance proceeds which we have received due to in COVID situation. It only deals with as a support or an ex gratia if you have received from some other person, then it will not be taxable. Insurance proceeds will still be continue to be governed by the existing provisions. Whether it falls under the exemption of 1010D, you will be eligible for that benefit. If it doesn't fall under 1010D, you will not be eligible for that tax exemption. And income tax return file who has not filed IT return, can such assessee file updated income tax return as per new amendment? Yes. So this updated return option is available for assessees who have filed returns or who have not filed returns also can go for this. Obviously subject to payment of that additional tax and normal tax, etc. Question about 194 IA. When we purchase a flat for which possession is due and the amount being paid is say 100 lakhs, then for an assessable value of such property, should we take a valuer report, or how do we determine the correct assessable value as per the stamp authority for the same? So definitely you will so that you will have to, in most of the cases, if you from a RERA perspective, you are, let's say you are buying a property which is already registered in RERA. So at the time of booking a flat itself, you will be registering that flat for stamp duty purposes after payment of 10%. So that point in time, you will get a clear idea of what is the stamp duty value and what is the transaction value. In case if you are entering into a transaction which is not wherein the agreement to sell is not registered, then definitely you will have to, we not necessary to get a valuation report. These days, circle rates or stamp duty value are easily available over websites, and there are specific dedicated websites also which are provided by a few states, wherein you put in specific query about a particular property seeking the stamp duty value of that property, and you get that thing. You can just simply put in that query, take it out, keep print out of it in your file, and use it for future assessment. So you need valuation report is not mandatory in that situation. Is the 2-year extension of correction of IT return applicable for financial year 1920 and 2021? So this updated, we are waiting for the formats and detailed rules for these updated return. Then only will be in a position to comment ki will it permit for financial year 1920 and 21 as well. I am an unlisted company. Can valuation report under Rule 11 UA used for the purpose of perks? I'm really unable to understand exactly what this question wants to. What this question is for? What perks we want to value under 11 UA? Because 11 UA is primarily for shares, securities, and jewelry, archaeological collection. Those things. For those, the Rule 11 is prescribed, not for the purposes of perks. Then there are few questions to Sharji relating to GST only. I'll just quickly see if there is one question. Last question: who is a specified person to decide the TDS limit under cryptocurrency? So that the specified person has been defined in that particular section only. If any person, an individual or an HUF who does not have a business income, or in case he has a business income but the turnover in the preceding year does not exceed 1 crore, for those cases the limit for deduction of TDS under for cryptocurrency is 50,000. In all other cases it is 10,000. I think Tusharji, direct tax queries, I think I don't see any other points on direct tax. There are I can see few questions on GST. You can go ahead to answer them.
Yes, there are a couple of few questions on GST. So first is, what is the difference between 2A and 2B? See, 2A and 2B both are a kind of an MIS report which give details of the invoices uploaded by the supplier in their GSTR1 and auto-populated in your GSTR2A or 2B. So in case of GSTR2B, it is a static document. Whosoever supplier files their returns by within the due date, only those invoices get auto-populated in GSTR2B. Let me take an example. For the month of, say, January 2022, if the suppliers are filing their GSTR1 by 11th or 12th of February, the same will get auto-populated in your GSTR2B of the January month itself. However, if some of your supplier files the return on, say, 16th of February, GSTR1 return, in that situation, you will not get this invoice in your GSTR2B of the January month. You will get this invoice in your GSTR2B of the February month. Whereas when I compare it with GSTR2A, GSTR2A is dynamic. So even the supplier files their GSTR1 on 16th of February for the January month, and you download your GSTR2A, say on 17th or 18th of February, you will get this invoice on GSTR2A. So GSTR2 is dynamic. It keeps on evolving, keeps on changing based on the returns filed by the supplier, whereas GSTR2B is static. So as of now, the only concept which is prevalent from January onwards is, because Rule 36.4 has been amended, Rule 16.2AA has already been introduced, and apart from now, Section 38 has also been introduced. So only return which is prevailing is GSTR2B. GSTR2A is over. In simple terms, from January 2022, GSTR2A is over. It is only GSTR2B which will be matched. Moving on, again, like one of the question raised is, the time limit for taking the credit is 30th of November. But why are we saying that it can be taken only in October return period? See, you cannot take any credit in your books of accounts. See, in GST law, the time of availment of credit is when you show that in your GSTR 3B and file that particular return. So whenever you file your GSTR 3B in which the credit is taken, that day it is auto-populated in your credit ledger. So that is the day on which availment is set to be done. So you can avail only up to 30th of November. Until 30th of November, which return you can file? You can only file October return. You cannot file November return by 30th of November itself. So the only return which is available to you is your October return. That's why you have to take all your credits in your October return, which you have to file by 20th of November. Even if there is a delay of 10 days and you file it by 30th of November, credit will be available. And in fact, the 43rd Council meeting agenda also says that this relief is given only for one single tax period. And one of the question raised is, if GSTR1 is higher for a particular month and GSTR3B is less. Whereas I have done this amendment and it was a clerical mistake in GSTR1. Say for April month, I filed my GSTR1 10 lakh rupees, GSTR3B 2 lakh rupees. Whereas next month I rectified it. Now you are saying that for the April month, etc., since there is a big difference between GSTR1 and 3B, now will customer face any credit because of Section 38 implementation? See, what Section 38 says is that they will look for those suppliers wherein there is a difference between GSTR1 and 3B of the supplier. The supplier credit is not matching with 2B, etc. So they will look for certain suppliers. So there will be a logic which will be implemented in the system. It's not that based on one month data itself, they will select that these supplier invoices are not creditable. So we all have to wait on the logics which will be implemented on the GST portal. There will be certain check and balances logics which will be implemented, and based on some 2 to 3 months cumulative data, they will decide whether it's an right vendor or there is some problem in the supplier, and accordingly put restriction in the credit. So how Section 38 will at ground level be implemented is yet to be seen, because there can be actual practical reasons for differences between GSTR1 and 3B or any of his reconciliation, etc. So on how they will actually restrict the credit is yet to be seen. So we have to wait to see how portal will work, what logics will be implemented. For the period 21-22, whether the last date of claiming credit is September 2020 or November 2022. See, it's only a finance bill as of now. So once the finance bill is enacted, and then only this amendment will be applicable. So as of now, it is September 2022. However, if the finance bill gets enacted before September 2022, then it will be November 2022. So if this is only a proposed amendment, it is not yet enacted. So if the enactment takes place before September 2022, in that situation, the time limit will be November 2022. However, if an enactment does not take place, then it will be September 2022. I think we have covered most of the questions. We thank everyone for joining these sessions. And if there is any question which is yet to be answered, we are writing our email IDs on the chat box. You can mail us and we'll be happy to answer back. Abhishek ji, you can also write your email ID on the chat box for the benefit of everybody.
Thank you, Tushar ji. Thank you, Abhishek ji, for the interactive and informative session.
Thank you, sir. Thank you, sir.
And thank you all the
Thank you,
participants.
sir.
Thank you, everyone. Stay safe.
We will share the PPTs of the both session on your mail IDs which you entered in the registration. Okay. So thank you everyone.